How are indices poised, Dean? The S&P, for example, is poised at a critical sort of juncture. Just under 4,100. You think we'll get there beyond that? Here in India, the market, of course, took a little bit of a breather, but we had a good rally. What's your sense?
Yeah, so I think the biggest question is a really important week this week. So we have the Fed policy rate coming out on Wednesday. So what we know and what the market has priced in is an inevitable increase in the Fed policy rate. So we should see Fed raising Fed fund rate by 75 to 100 basis points on Wednesday, which will bring nominal Fed fund rate to about 2.5%. And if you look at the dot plot, the Fed fund rate is projected to go as high as 3.75 by the end of 2023. What's also partially priced in is the potential slowdown or recession in the U.S. economy as we enter second half. If you look at the 2 to 10-year bond yield has inverted, which signals a recession sometime in 2023. But in our opinion, what is not priced in is how much of an earnings decline are we going to face going forward. So already the market is estimating a slowdown in earnings growth for 2023. And estimates have been down. We've seen downward revisions in the last 4 weeks. So it's a very important week. We have all the FANG companies reporting. And if Snapchat is any indication, or Walmart, any miss in earnings or poor guidance may prompt a retesting of the lows. So we see the S&P resistance 4% higher from here at the 100-day moving average. But it's important that S&P kind of finds stability of support at the 50-day moving average, which is like 1% away. And so really critical week. Now, on a more positive side, I would say if you look at inflation break-even rates, which forecast where inflation is headed, the 1-year and 2-year break-even rates are estimated to decline 3 to 3.5% from the lofty levels that we are seeing currently. So the silver lining in the situation is that Fed may start cutting rates or become more dovish at the start of 2023. And depending on the speed of recession, they may be forced to cut rates more dramatically. So once the market gains confidence that this scenario will likely play out, then we may see the bottom of the market soon, as the market is always a leading indicator. So okay. That's the kind of scenario we're looking at.
Dean, hi, good morning. The issue here is that while the classical definition of recession, 2 successive quarters of GDP contraction, might become a reality, the US president is still firm that US is not heading into recession. So from the market point of view, do you think the markets made some kind of a low on the recession fears, or do you think if we actually have the US going into recession, we could break the lows?
Well, I mean, we are slowly starting to see signs of slowdown. Although, the government may wish that we don't fall into recession, it may be inevitable that we do. For example, we're seeing, auto loan defaults rising. Disposable income has actually declined 12% in the last month. And although, labor market is quite strong, unemployment rate is still very sticky at around 3.6%. That may all change as we go forward. So, the bond market is a pretty, clear indicator of where we're going, right? When you look at it historically, and they are signaling a potential recession down the road, let's say starting 2023.
Okay, this is serious. So you're saying that there are stark signs of a slowdown now, and there's a rise in auto loan defaults. It's generally a barometer of the spending power that people have, right? That brings us to the question about Walmart, because that's the big headline where Walmart has cut their profit estimates and their guidance for the full year. If spending is going to suffer, if inflation is going to hit people's pockets, do you see that have a larger impact on asset classes like equities? And how do you extend that to a market like India, which has done well so far?
Yeah, I mean, I think U.S. We're not out of the woods. If I look at on a technical basis, if I look at S&P and the triple Qs, we're kind of in a no man's land right now. We do see huge resistance at the 100-day moving average, which is about 3 to 5% away on the upside. Once we reach that, we may see a lot of selling into that, and so I think we have to be very patient and cautious, because there are a lot of headwinds coming our way. Now, India, on the other hand, is a very resilient market. I continue to see organic growth very strong, 10 to 20%. One of the best spots globally, actually. When you look at India, it's not only do you have rising income, rising middle class, as well as very strong GDP growth rate relative to other developed countries. You have banks growing at 20% year over year. ICICI just reported their earnings; they beat estimates. Loans are growing 20%. You can't find that anywhere in the world. So I think India is the engine for the rest of the world, and that's why it's benefiting from it. Now, having said that, we still do see some resistance level coming up for the Sensex at the 200-day moving average. I think it's very important that Sensex reclaim that moving average. And then we do see support at the 100-day moving average, which is 1% below. So hopefully the index could find support there and kind of consolidate and move forward. But there are a lot of ideas setting up constructively. Plethora of good ideas in India.
Okay, so you're saying you see the support for this market at the 100-day moving average, which is 16,524, right? So if that is the case, what are the stocks that you'd look to buy now, Dean? Where do you see the maximum potential?
Yeah, if I look at all the sectors, a few of them stand out. For instance, autos, it's just starting to break out now. So you have like Bajaj Auto, Tube Investments, Asahi India Glass, Cummins India. All of these companies are doing quite well. And I think it's on the back of consumers, buying more autos as we head into the second half. And then the next area is cap equipment. So, companies like CG Power, SKF India, Adani Enterprises, continues to do very well. And then I would say banks, banks are starting to see some life. State Bank of India looks great. Federal Bank is breaking out. Bank of Baroda also. And then Mahindra Financial Services. ICICI, is setting up on the right side of the base. So it's looking very constructive. And, that may be a worthwhile, a trade in terms of starting to accumulate a small position there. HDFC, Kotak Mahindra, Kotak Bank, not ready yet. Let it consolidate further. Needs to digest all the downside move for now. And then lastly, I would say consumers. So FMCG, so ITC, Hindustan Lever, Unilever, Britannia, all of these names are looking great.
All right, lots of ideas. I mean, a lot of them, of course, are I've seen large momentum, but these are technical ideas, right, Dean? Technical charts, most of them.
Well, technical and also fundamental as well.
Sure.
Because when you're looking at FMCG, I think the monsoon is going to help out greatly.
Sure.
And then
Sure.
yields are about to rise. So all of these factors, they're baking into the stock prices, and that's what we focus on.
All right, Dean. Thanks very much. Great speaking with you. Appreciate you joining us with that